My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends, just trying to make a little money. My job is not just to entertain, but to educate and teach you, so call me at 1-800-743-CNBC or tweet me at Jim Cramer. Every day, we have to listen to the narrative of why this market goes up or down on a different set of facts. Every day, there's a good chance it's totally made up. Last week, we supposedly went down on higher interest rates and higher oil. Reasonable alibi, right? But today we got slammed in the morning, despite oil and interest rates both going lower. Although the market ultimately corrected itself, Dow gaining 140 points, S&P inch up 0.15%, Nasdaq advanced 0.17%. Problem is, earlier today, we had people explaining the market's decline, as it was down most of the day, by pointing to lower oil and lower rates. They made it clear that the combination of low oil and low rates is just as bad for the market as high oil and high rates. This stuff's driving me crazy. Feels like it's a game of heads the bears win, tails the bulls lose. That's not right. Now, we can try to thread the needle here. When rates keep going higher, we are likely headed for a slowdown. When oil goes up, it is indeed inflationary, which tends to push rates even higher while sending most stocks down. I accept those as legit culprits for a down day. Makes sense to me. But if interest rates and oil are both going lower, okay, rates going lower means earnings could be going lower as there might be less demand for money, and oil going down could be a sign of an impending recession, especially when oil's down 8% in just 5 days. You could easily argue that demand must be falling off a cliff. Sounds smart. Was the prevailing verdict for most of the day. But you know what? It would also be total poppycock. Nonsense. Not in this show. We don't play that game in this show. Not after all these years. I refuse to follow this ridiculous orthodoxy, one that fools the public, one that fools you, makes people give up on the market in pure frustration because the whole thing makes no sense. And you're right, it doesn't make sense. So let's parse what really happened here today. First, as an old headline writer for a daily newspaper myself, I can tell you that the whole process is indeed flawed. You need to shoehorn a day's worth of action into about 30 words max. These journalists have to look at the scenario and just pick some explanation that seems to make sense. It might make sense for a given day or a given morning and early afternoon, as was the case today, but it certainly makes no sense if you take these headlines as gospel, and many of you do because you don't know otherwise. And I don't blame you. See, you can't have two opposing forces, higher and lower oil, higher and lower rates, in the same space. It doesn't happen in real life, and it doesn't happen in the stock market. But these bogus explanations lend themselves to headlines, and unfortunately, there has to be a headline. They can't say, I'm sorry, this session doesn't lend itself to that kind of shorthand, or they'll get fired. Better just draw a superficial conclusion that doesn't hold up to close scrutiny, but everyone's in it already, so what? Second, remember, the market is not a monolith, so the reactions to the same inputs might be different if those inputs are caused by different reasons. Let's take oil. Last week, oil was going higher. I think because there was a sense that Israel was going to launch a ground offensive in Rafah, which everyone assumed would get really ugly, something that might trigger a reaction by OPEC that would cause oil prices to skyrocket. Hey, people hoarded crude in anticipation of that. But while Israel did send some ground troops in, that doesn't seem to have been enough to trigger its oil-producing neighbors into taking action, rightly or wrongly, not trying to draw conclusions. How about oil's decline this week, though? This is what we have to talk about. This time, I think it was because the people who hoarded last week decided to dump the oil. They didn't need it. More important, we realized that the true level of oil production may be too high versus these prices. Oil's been volatile since the Israel-Hamas war started, because there are so many ways this conflict could spiral and impact the oil market. Hey, by the way, let's be really clear about this. Hezbollah is now launching rockets at Israel from southern Lebanon. And if Israel moves in, it could again provoke OPEC to slash production. OPEC hasn't done anything yet. Iran hasn't done anything yet. But I wouldn't, well, they've launched some missiles. I don't want to say they haven't done anything yet. But I wouldn't get complacent about the price of oil plummeting here. It most likely won't because of a possible northern front in Israel. Next, you should almost never argue that interest rates going lower is negative for the stock market. People threw it around this morning. This is really difficult. If this were a court of law, I'd say the burden of proof is on those who think that lower rates reflect economic weakness. There's so many positives to rates going down that you simply can't equate the two like people did so glibly earlier today. One, higher rates can cause real damage to the stock market. The other, lower rates, unless there's some sort of cataclysmic risk, almost never do. They're almost always bullish, so don't buy into that. When rates go down, stocks with dividends become more of a bargain versus the bond market competition. They can do off and rally just on rates alone. When rates go down, that means inflation is most likely going down. So stocks are worth more because their future earnings streams will have more purchasing power. When long rates go down, it could be a sign that the Fed is about to cut short rates. And we know this market's desperate for rate cuts. Higher long rates obviously signal the opposite. Given that retinue, anyone who's looked at the market sell-off earlier today and said, hey, lower rates are to blame, well, they did you a real disservice. They're the people keeping you from investing properly. How should they have described the action? All right, in a perfect world, where headlines could be as long as you wanted, I think you'd say something like this. Despite a declining oil price and lower interest rates, stocks initially struggled as some major themes that had powered us higher seem to have us stymied. Many stocks have been going higher because of the endless data center build-out that requires huge amounts of equipment and power. But last week, Dell reported a number that wasn't in sync with the thesis, and so far nothing has contradicted them. Given that the hyperscalers have the money to build as many as $6 billion data centers as they need, we have to conclude that this artificial intelligence industrial revolution may be overblown. Plus, we have a bear market in the once explosive enterprise software cohort. There, end. That's it. That's the headline. It's too long, I know, but that's what's going on. Now, I don't actually believe that that Dell's going to prove to be correct. I actually believe there's going to be a lot more data centers, but that is the explanation for the recent action. However, I would add, we need to see weakness across the board for the Fed to make a move. We need to see commodities lower, which is the case with pretty much every commodity in the last 5 days, not just oil. We need to see job openings diminish. Now, we got that today. And we need to see lots of layoffs. No, we're not getting that. And that's the problem. I don't want layoffs. You don't want layoffs. But we need to see lots of layoffs, which means that Friday, when we get the Labor Department's non-farm payroll report, it could undo any perception of a slowing economy that we're getting from some of the data we just see. We just don't have enough information that wages are headed lower or that jobs are harder to get. So today's what I call work in progress from the Fed's perspective. And that's really how I want to leave this. You get a day like today, it's a work in progress towards a rate cut, hence why we rebounded in the late afternoon. We have days like today that are good setups for a rate cut, but that doesn't give us enough evidence to truly move the needle. Without enough evidence, we can sell off briefly before ultimately finishing up slightly. That was today's session. Look, I know it's prosaic. I know it lacks punch. It doesn't make things simple. But things aren't simple, people. And if we try to make them simple, we get you confused. I belong to the first to no harm school of thought, which means I'm willing to smash the orthodoxy, the jail cell of 30-word headlines. Those stocks that don't fit into the long-winded direction I just explained, those are probably the best opportunities because they're probably wrongly valued, distorted by a large seller or a buyer who simply doesn't know how to trade in and out of something without moving it in an excessive direction. That makes no sense whatsoever. And there are a lot of bad people, bad traders out there with no skill set. But the bottom line, the next time you see some glib headline explaining the day's action, remember, that headline is not to be taken as gospel. Sometimes right, sometimes wrong, but they're way too simple to ever be treated as truly definitive. And they will not help you make money. They will abet losses or make you leave stocks entirely. Let's go to Mark in Iowa. Mark.
Hi, Jim. I'd like to give a shout out to Dolores, a wonderful lady who's working hard to recover from a hard fall last Friday.
Oh, geez, of course, absolutely. We're all thinking of her, okay?
Thank you. I'm a charter member also of the CNBC Investing Club, and I'm really happy with the early call on Best Buy.
Thank you. That was a good one.
Yeah, it still has a lot of room to run, so you and Jeff did well on that one.
Thank you. Yes, we got that one right. Thank you.
Jim, I was watching Squawk Box this morning and had to wonder if meme stock mania could have an adverse effect on one of our club stocks. Roaring Kitty trades on the E-Trade platform, and more than once today I heard talk that they may have to expel him from the platform. Could this happen? And if it does, if it angers some people, could this put Morgan Stanley in a no-win situation, no matter what they do?
Mark, it is just I was addressing that directly with David. We know that you want more trading. We want that whole cohort, the Reddit cohort. We want them in, not out. We want the Wall Street bets people in, not out. I am concerned about that. I know that that may not be big ticket, but it does impact the way people feel about a firm. I'm hoping Morgan Stanley keeps them in and just teaches everybody to do a little bit of better job. That's what we want, is teaching. All right, sometimes headlines explaining the day's moves are right, and sometimes they're wrong. But either way, please don't take them as gospel. Everybody, tonight, AstraZeneca shared some extraordinary data on a few of its cancer treatment drugs this week. So where do we stand on the fight against lung and breast cancer? I'm sitting down with the company's top brass. You don't want to miss that. Then don't miss my off-the-tape exclusive with Databricks. I'm checking in with the cloud company's CEO. Wow, what a horse that is. And later, Cisco CEO is joining me from the company's Cisco Live event in Las Vegas to talk about some of the hot-off-the-press announcements that he has in the world of AI and others. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.